Welcome to vTalkInsight Allocator's Lens Daily for December 20th, 2025. Across assets, markets are trying to reconcile powerful AI-driven earnings, heavy equity inflows, and firmer metals with a world of shifting central banks, rising global yields, and lingering governance questions at the Federal Reserve. We will connect those threads across equities, rates, credit, currencies, and commodities from a portfolio perspective. In equities, the dominant story is still earnings and AI support, set against increasingly stretched positioning and sensitivity to rates. Record inflows into global stocks, including one of the largest weekly moves into United States equities on record, show investors remain eager to buy pullbacks despite already rich valuations. For the S&P 500, most of this year's gains have been earnings-driven, and forecasts now cluster around 11 to 13% profit growth this year and next, leaving limited room for further multiple expansion. The AI earnings cycle is central to that optimism. Large technology platforms, especially the so-called Magnificent Seven, continue to post strong double-digit profit growth and upward revisions, even as headline forecasts for sector earnings have been trimmed from roughly 23 to about 18% for next year. Investors are becoming more selective within the AI trade, focusing on companies with clear free cash flow, visible multi-quarter revenue pipelines, and credible returns on massive data center investment, rather than rewarding every AI-linked narrative. On the infrastructure side, hyperscalers and providers like Oracle are leaning into very large data center commitments, supported by rapid revenue growth at partners such as OpenAI and approvals for gigawatt-scale campuses. AI adoption is moving from experimentation to core business processes, boosting demand for inference workloads and compute capacity, and laying the groundwork for a robust initial public offering calendar among private AI and software firms that have already reshaped their models. Upcoming frontier model launches from OpenAI and Meta in the first quarter are seen as key catalysts that could re-energize technology sentiment, even as scrutiny of valuations intensifies. Importantly for allocators, leadership is no longer purely a mega-cap technology story. There is clear evidence of a broadening rally, with financials, biotechnology, entertainment, and healthcare showing positive earnings revision momentum and, in some cases, record highs helped by AI-driven productivity gains. Value stocks have started to outperform growth for the first time since 2021. Institutional capital is rotating from communication services and information technology into financials, utilities, and industrials, and expectations for a steeper yield curve in 2026 support ongoing interest in banks and large cyclicals. Below the mega caps, the outlook for mid and small caps is also improving. Commentary points to potential tailwinds from fiscal transfers, a future Federal Reserve easing cycle, targeted deregulation, and active mergers and acquisitions, all of which could help reverse their multi-year underperformance against large caps. Globally, there is less conviction that United States equities will continue to dominate in 2026, with Japan and China singled out as regions to watch, while Europe looks more constrained after a year, when currency moves did much of the heavy lifting for returns. Beneath the index level, consumer and sector dispersion is increasing. Nike's earnings miss, sales warnings, and persistent weakness in China, alongside Converse brand declines, highlight how company-specific execution and tariff exposures can overwhelm the broader macro narrative, even as North American operations show cleaner inventories and improving gross margins. By contrast, FedEx has delivered strong parcel growth and is still viewed as having room to retest prior highs over time, while large food and beverage companies are starting to cut prices, which may help volumes, but also underscores pressure on lower-income consumers. Positioning and technicals add another layer of fragility. Allocations to equities remain stretched relative to bonds. Retail participation is robust with leveraged exchange-traded funds at all-time highs, and speculative pockets, such as meme stocks and fringe AI, plays remain active, even though dip buying has become less aggressive. The volatility index spiked midweek before sliding back toward the mid-teens, and a record options expiration has cleared significant positioning overhangs, potentially allowing indexes to move more freely in response to macro surprises. All of this sits on top of a rates backdrop that can either support or undermine the equity story. Several analysts flag that a sustained rise in 10-year Treasury yields above around 4.5%, especially if they approach 5%, could puncture the current bullish narrative and end a reflation phase that has supported earnings-driven multiple stability. At the same time, governance risks around the next Fed chair, doubts about recent inflation prints, and growing political pressure on the central bank raise the prospect of more policy-induced volatility that could test today's optimistic equity targets of roughly 7,400 to 7,600 on the S&P 500. For multi-asset portfolios, the takeaway is a constructive but more two-sided equity outlook. Strong earnings, AI-enabled productivity gains, sizable fiscal stimulus to households and corporates, and improved breadth all argue against an imminent end to the bull phase, but stretched allocations, concentration with technology and information services now exceeding 45% of the index, and late-cycle consumer strain leave markets vulnerable to policy or yield shocks. Key watch points include long-end United States yields around the 4.5% threshold, the breadth of earnings revisions beyond the mega caps, and any sign that heavy equity inflows start to rotate back toward fixed income. With that backdrop in mind, the natural next step is to look directly at the rates markets shaping those constraints. In rates, the core message is that policy is mildly restrictive, data are noisy, and global divergence is widening. Federal Reserve officials see the real policy rate at roughly 1 to 1.25%, a bit above their estimate of neutral, which means monetary policy is leaning against inflation without being viewed as excessively tight. Recent core inflation has fallen to multi-year lows, but quirks such as assumed zero rental inflation and data collection issues around government shutdowns make the latest consumer price readings less reliable, encouraging the Fed to sit tight and wait for clearer evidence. The macro backdrop gives the Fed room for patience, but not complacency. United States gross domestic product growth is expected to slow to around 1.5 to 1.75% this year, then rebound toward roughly 2.25% next year, helped by AI investment, loose financial conditions, and sizable fiscal transfers to households and corporates. Officials broadly expect policy rates to decline over time as inflation converges on the 2% target, with some projections for 10-year Treasury yields drifting below 4% by 2026 as inflation and policy rates fall toward about 3%. But they see no urgency to deliver cuts immediately. Long-end yields remain the critical swing factor for both bonds and risk assets. One camp anticipates 10-year yields oscillating around roughly 4.15% near term, with a steeper curve that benefits banks as short rates eventually come down. Another warns that if global forces push 10-year yields above about 4.5%, especially toward 5%, that would challenge the entire reflation and equity bull narrative. Those global forces are real. The Bank of Japan has raised its policy rate to the highest level since 1995, lifting 10-year Japanese government bond yields above 2% and ending Japan's role as the world's lowest cost lender. Higher yields in Japan risk reducing local demand for United States treasuries and European sovereigns, just as the euro area prepares to issue more joint debt to fund a €90 billion package for Ukraine, and Germany plans substantial infrastructure spending. The European Central Bank is signaling that its cutting cycle is likely done for now, citing resilient growth and sticky services inflation, while the Bank of England has begun easing, but is hinting at a slower path of future cuts than markets once assumed. Despite this, United States bond market volatility, captured by the MOVE Index, is back to its lowest level since 2021, suggesting markets are not fully pricing the risk that policy divergence, fiscal expansion, or further Bank of Japan tightening could reprice curves sharply. For allocators, the rates narrative boils down to thresholds and sequencing. A world where the Fed keeps policy mildly restrictive for a while, inflation edges down, and 10-year yields trade in a stable low 4% range is broadly compatible with the equity and credit optimism we see today. A world where governance frictions at the Fed, further Bank of Japan hikes, or expanded European borrowing push global yields materially higher could instead force a repricing across risk assets. Against that backdrop, many portfolio teams are monitoring the 5 to 10-year segment of the Treasury curve as the key risk transfer point when equity volatility spikes, even as they recognize that current low-rate volatility may understate the range of possible outcomes. That sensitivity to long-term rates leads naturally into the credit picture, where benign surface conditions sit alongside more fragile plumbing. Credit markets still look calm on the surface. Spreads in public markets remain tight, and deal activity is robust, with mergers and acquisitions volumes up roughly 40% year-on-year as chief executives take advantage of open funding windows and ample capital access for higher-quality borrowers. Banks are leaning into this environment. Wells Fargo has expanded its investment banking footprint, arranging large facilities such as a $30 billion bridge loan for Netflix, while groups like BBVA are authorizing sizable share buybacks that underscore strong capital positions. Below that calm surface, however, several pressure points are building. Private credit has grown rapidly to around $1.7 trillion, raising questions about underwriting standards, deployment quality, and how stresses might propagate back to banks that lend to these vehicles or share exposure through co-lending structures. Episodes of funding market strain, such as the recent 35 basis point spike in the spread between secured overnight financing and federal funds, showed how quickly liquidity can tighten and trigger sell-offs in more speculative assets. The future path of policy will be critical for how these risks evolve. Expectations for eventual Federal Reserve rate cuts, alongside similar or slower easing in other markets, would, if delivered, ease pressure on interest coverage ratios and help stabilize parts of the private credit complex despite its rapid growth. But if cuts are delayed, shallower than expected, or overwhelmed by further global yield shocks from the Bank of Japan or Europe, weaker credits and deal structures completed at peak valuations could become focal points for stress. For cross-asset allocators, monitoring delinquency trends, bank exposures to intermediated private credit, and the terms of new M and of financing offers a practical way to gauge whether today's tight spreads remain justified. Currency markets are expressing many of these policy divergences in real time. The Bank of Japan has lifted its benchmark rate to about 0.75%, a 30-year high, and 10-year yields are at levels last seen in the late 1990s. Yet the yen has weakened further, even dropping around 1% after the latest decision. Markets expect only gradual hikes roughly every 6 months, and a lack of firm guidance, combined with still loose fiscal policy, has encouraged investors to keep selling the currency unless or until direct intervention appears. In Europe, differing central bank trajectories are also shaping foreign exchange dynamics. Markets may be underestimating the likelihood of further Bank of England cuts over coming meetings as weak retail sales and softening labor data increasingly outweigh inflation concerns, which gives an underlying bias for sterling to remain under pressure, particularly against the European Central Bank that now signals its own cutting cycle is likely complete for the time being. For the dollar, broader measures of underemployment and a softer labor market support the view that the Fed may eventually ease more aggressively than current pricing implies, which could weigh on the greenback in early 2025, especially if other major banks move more cautiously. Digital assets now sit firmly in this currency and policy intersection. Security risks remain elevated, with North Korean-linked hackers responsible for a large share of the billions of dollars stolen from the crypto industry this year, and personal wallet attacks still common even as total theft volumes decline. At the same time, nation-state use of cryptocurrencies is rising, exemplified by Russia's ruble-backed stablecoin facilitating tens of billions of transactions and raising fresh questions about sanctions evasion and de-dollarization. Regulatory architecture is evolving in response. The confirmation of a new CFTC chair with deep experience in digital asset enforcement and the progress of market structure legislation in the Senate point toward more formal oversight in the United States. While a consortium of major European banks is designing a single euro stablecoin standard for wholesale payments and settlement of tokenized assets. Stablecoin issuers themselves are now significant buyers of United States treasuries, meaning developments in this space directly affect sovereign bond demand as well as the broader currency system. For allocators, FX is therefore no longer just about rate differentials and trade balances, but also about how digital money, regulation, and geopolitics reshape capital flows. Commodities add an important inflation and growth dimension to today's cross-asset picture. AI-driven data center build-outs and stationary storage batteries are set to drive strong demand growth for copper, aluminum, and lithium next year, with AI alone expected to account for roughly one-third of incremental copper demand. Forecasts point to tight supply-demand balances in scope for metals such as uranium, lithium, copper, aluminum, and even gold to outperform consensus in 2025 and 2026, especially if anticipated Federal Reserve cuts and a weaker dollar materialize. Precious metals, particularly gold, are already reflecting that backdrop. Gold and silver are trading near record highs, supported by rising expectations for rate cuts, ongoing exchange-traded fund buying, and heightened safe haven demand amid geopolitical tensions, including disputes involving Venezuela. Some houses now see a path for gold prices toward around $4,800 to $4,900 per ounce by 2026, arguing that non-yielding assets should benefit as nominal and real rates drift lower and policy uncertainty persists. Oil, by contrast, is acting as a powerful disinflationary force. Global crude markets are in significant surplus, with Brent prices having slipped below $60 per barrel, tankers idling at sea, and forecasts for average prices in the mid-50s by 2026 as production from the United States, Ghana, and OPEC Plus continues to outpace demand. OPEC Plus has paused further production increases in response, and there are scenarios where disruptions to exports from Venezuela or Kazakhstan could briefly tighten balances, but the starting glut limits immediate upside and contributes to the softer inflation profile that central banks are monitoring. Bulk commodities tell a similar story of mixed signals. Iron ore faces headwinds from weaker Chinese demand, high port inventories, and new supply from regions such as Guinea, though higher cost curves may set a price floor. Looking across the complex, strong metals and precious prices alongside cheap oil create an unusual combination of inflation-hedged demand and growth optimism, paired with an energy component that helps restrain headline inflation. How that balance evolves will feed directly into inflation prints, rate expectations, and ultimately the risk-reward trade off across equities, rates, credit, and currencies. Pulling the threads together, cross-asset markets are wrestling with an earnings-rich, AI-enabled equity story, a mildly restrictive but increasingly divergent rates backdrop, and a commodity complex where strong metals and gold coexist with an oversupplied oil market. Credit conditions remain benign on the surface but are more fragile beneath, given rapid private lending growth and periodic funding stresses, while foreign exchange and digital assets amplify the impact of policy divergence, regulation, and geopolitics on capital flows. For allocators, the balance of risk hinges on how long end yields evolve, whether the AI earnings cycle broadens sustainably beyond the current leaders, and how quickly commodities and currencies feed back into inflation and central bank reactions. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.